started the meeting.
Okay. Hey, good morning, everyone, and welcome to another edition of the Montgomery County Chamber of Commerce's Economic Development Committee. I am Brian Levine. I am Vice President of Government Affairs for the Chamber, and as we do for most or all of our committee meetings, we do record these, so please note that. This committee meets several times a year, usually on the first Wednesday of the month, which is what this is, I think, yeah. And just a quick advertisement, actually this is the second Wednesday of the month. Sorry, we moved this meeting from February 1st to February 8th. Thank you, Andy, for being able to do that. Just a quick advertisement for our next couple of Economic Development Committee meetings that have come together just in the past week or so, and we will post on our website and get word out to you on. On March 1st, we're going to host Jake Weissman. He's the Assistant Chief Administrative Officer for County Executive Elrich in Montgomery County. And Jake's portfolio is everything relevant to this committee, everything economic development. So we're excited about that. And then on April 5th, we have Ralph Hall, who is a professor at Virginia Tech, who is going to be a guest speaker and cover all kinds of topics. I think we're still honing that, but I think some of his specialties include topics like putting an equity lens on economic development and the role of anchor institutions and how they invest in their community. So that one really should be great as well. That's April 5th. But today we're honored to have Andy Bauer, who I will leave for the chairs to introduce. But I've seen Andy a couple times now, and these talks that Andy gives are really good and really valuable. I know I personally really enjoy them, so we hope you do as well today. So I mean, just to kick the meeting off and maybe introduce our chairs, I'll just hand it over and introduce our President and CEO, Gigi Godwin. Gigi, take it away.
Good morning, everybody. I'm Gigi Godwin, President and CEO of the Montgomery County Chamber of Commerce, and we are all about economic development and opportunity for our businesses. And one of our focus points is to bring you thought leaders that are helping to shape the future. And certainly the Federal Reserve and Andy Bauer fits that bill perfectly. So we're very happy to have Andy with us this morning. And with that, I'm going to stop and turn it over to our chair so that we can introduce Andy and hear what he has to say. Thank you.
I'll just say a quick good morning and then turn it over to
Joan, we're having trouble hearing you.
you can't hear me?
Yes, if you come very close, we'll be able to hear you better, I think.
Let me see. I have this problem. Is that better?
Better.
But I'll make it very brief. Always a pleasure to see you. Thank you for being here. After the State of the Union last night, the presentation was that much more interesting. And economic development, security. Looking forward to it.
Thanks, Joan. Good morning, everybody. Thank you, Gigi and Brian. Andy, welcome. It's wonderful to have you here. I've had a chance to meet you a few times, and we're really excited about your talk this morning. This is a great way to kick off our economic development calendar this spring. We can say spring now because we know spring is in the air. So, Andy, I'm going to give a brief introduction and then hand it over to you. And then, as you know, this group, there will be lots of questions and engagement following your remarks as well. So let me, I have the privilege to introduce Andy Bauer. Andy is Vice President and Regional Executive for the Baltimore branch of the Federal Reserve Bank of Richmond. And he serves as the lead external facing officer for the Richmond Fed in Maryland, the greater Washington metropolitan area, and West Virginia. And in this role, he provides support to the bank's monetary policy responsibilities and leads the execution of the bank's external engagement strategy. Of course, Andy is deeply engaged in gathering economic intelligence through all of his engagement with business, financial entities, academic institutions, the community, state and local government contacts, and groups like ours as well. And so today, Andy's going to provide a briefing on national and regional economic conditions and the Federal Reserve's role in our economy. And he's going to focus his remarks on important issues impacting regional businesses, including inflation and labor markets and growth prospects. So Andy, welcome. It's such an honor to have you here, and we're really eager to learn from you and engage with you this morning.
Well, morning. Thank you, Ann. Again, so in my role for the Federal Reserve Bank of Richmond, I spent a lot of my time talking with businesses. We value at the Richmond Fed a lot being out in the community and learning from business leaders. And so in between every FOMC meeting, we're trying myself, I've got two counterparts, two other regional executives, one in Richmond, one in Charlotte, as well as Tom Barkin. We're all out talking with businesses. And then part of our process for preparing for the FOMC meeting is we'll get together and we'll say, okay, what are we hearing? And after the FOMC meeting, Tom will, there's based on the discussion there and where policy is going, often there'll be, okay, Tom will say, it'd be really interesting to talk to people topic. And so we'll say, okay, so when we have conversation with businesses for the next cycle, there's certain things that we're going to want to know. So we'll be asking pointed questions. Often, I don't like to lead. It's kind of like, I don't want to lead the witness. I want to get their perspective, what's most relevant for them. And so I don't come in with saying, tell me about these things. But in the course of a conversation, obviously there's certain things that we always want to know about. What's going on with inflation, what's going on with hiring, and depending what's going on with the cycle, we'll ask certain questions. But so anyways, that's a lot of what we're focused on in Richmond Fed is really what we're hearing from businesses. And so a lot of my perspective is going to reflect that. And so I do have a set of slides to go through, and I'm going to try and go through those relatively quickly. Please feel free to stop me at any point in time. So if you have any questions, and because I'd really rather have an open conversation about what's going on in the economy rather than me just running through some slides. But the slides are helpful in that they help give a backdrop as to what we're seeing in the economy more broadly. So I'm going to share my screen, and hopefully I know how to do this at this point in time. So, Brian, can we see this? Okay.
It looks perfect on my screen, Andy.
Excellent. And so, so fasten your seatbelts. We have begun our descent. You could, depending on what you've been hearing and who you've been listening to, the descent could be. You might think of that in a lot of different ways. You might think of it as a soft landing into we're trending towards more trend-like growth, sustainable growth, or we might be descending into something a little bit more unpleasant and a harder landing. I'll just go ahead and say up front, I'm fairly optimistic about the outlook, and again, that's based in large part to the conversations with businesses that have been having, and I'll get into that. But I do need to say that the views expressed here are my own and not necessarily those of the Federal Reserve Bank of Richmond or the Federal Reserve System. So standard disclaimer. Now, just for the overview, again, we've heard a lot of people talk about recession, and it's been that I think this started almost, probably 3 quarters ago when we had negative GDP growth in the first quarter of last year. I think ever since then, people have been talking about, and then as the FOMC started raising rates, people started talking about recession. And so that's been on people's mind for some time. We weren't in a recession last year. And as we think about 2023, at this point, while certainly that's a possible outcome that we have a recession, right now, based on the data and conversations with folks, that's not something that I'm anticipating. Growth is expected to be moderate for a number of reasons. While supply chain, for the most part, has improved considerably, there are some places in the economy where we're still seeing supply chain problems. The international outlook remains challenging. What's really weighing on the economy at this point is higher prices for consumers, and then rising interest rates. And so we know that rising interest rates by design are supposed to dampen economic activity it increases the cost of finance for both consumers and businesses. And with higher inflation and a very tight labor market, the FOMC has been by design trying to dampen economic activity to a certain extent. We've seen some of that in 2022, but really not as much as one would think. And we can talk about why that might be. But we're anticipating to see that the impact of higher rates on economic activity in 2023, and so that will definitely help moderate the economy this year. Now, if you look at business confidence and consumer confidence, it's off considerably. Having said that, though, I'm still expecting to see solid consumer spending in 2023, and business investment, while you are seeing hearing from some businesses that they're postponing some opportunities. I'm hearing from many others that they're continuing with their investment plans because of a variety of different reasons. Now, one of the most interesting things perhaps at this point in time is that while people are saying at one point that, well, people are commenting that a recession is looming or is just around the corner, we're currently seeing one of the tightest labor markets that we've seen probably in a long time in U.S. economic history. So right now, the unemployment rate's at 3.4%. The pace of job growth has been tremendous. It has slowed from 2021 and early in 2022, but still the pace of job growth remains far above what would be considered normal if the economy were operating along a trend like growth. And so it's difficult to see how things would abruptly stop given the pace of hiring that we're seeing, because again, the tight labor market, labor is derived demand. Firms are hiring workers because they've got orders coming in the door, they've got customers that they need to service, and so they're not going to be hiring and adding to their costs unless they believe that the demand is there now and it's going to be there for some time. And so the labor market is strongly indicative that the economy is in a solid place despite all the challenges that we saw in 2022, and I think gives reason to believe that in 2023 there's considerable momentum going into this year. Now, I mentioned supply chains improving, but it's still an issue in some places, particularly in construction. If you talk certain construction companies, depending on the item or the material, while the time to get things in the door has improved considerably, there's still it takes some time. There's still certain backlogs, some of them can be quite considerable, and depending on the item, there could be certain uncertainty as to when they might get that particular part or equipment or material. So you're still hearing it in construction, but outside of construction, it has greatly improved. Plus, firms have just figured out how to manage longer lead times, and have figured out how to source from multiple suppliers, which has really helped. Then obviously the last 2 points are what's on a lot of people's mind. Inflation obviously remains very high. It has improved over the last couple of months. And so in September, if you go back and look at September, PCE PCE inflation and the core PCE were considerably higher than where they are now. We've seen a disinflation over the last 4 or 5 months, which is a positive development and is expected to continue in 2023. The question, of course, is how quickly can we expect inflation to move back down towards its 2% target? And again, there's an open debate as to how persistent is inflation. If you look at the inflation literature, there's a long literature which looks at the persistence of inflation, and that it's not expected to be, you just don't expect it to move quickly over short periods of time. And that just goes into the nature of contracting and price adjustments. If you think about it, we had, what we saw over the last 2 years, really over the last year, is, rapid price increases as people were adjusting the costs into higher costs, both on the material and labor side. And then you think going forward, are you going to see as many price adjustments that would result in inflation coming down quickly? And that just seems less likely. And I'll talk about why that is. A lot of that comes from, again, talking with firms and how they're thinking about pricing this year and going forward. And then lastly, the FOMC met last week and raised rates once again, but this time it's just 25 basis points. And so you're seeing that the FOMC has slowed the pace of rate increases. And going forward, and this is something that Chair Powell stressed in his interview yesterday with the Economic Club of DC, that it's really going to depend on how the data comes in, both on the labor side and on the inflation side. He was asked specifically about the jobs report last Friday, and that came in really strong. And so his interpretation, he was asked how he views that labor market with respect to policy decisions. He said, well, the tighter the labor market is, that means that the FOMC needs to be more vigilant with respect to inflation, because that if the labor market remains tight, it's more likely that the economy is going to continue to be strong, and that might necessitate rates to be higher for longer. But again, it's all going to depend. That's just one market, one labor report. So we'll see, what the February report says. But again, so just to stress, as we think about rates in 2023, it's really going to depend how the data comes in on both on the inflation and on the labor market side. And one would expect, with rates rising as rapidly as they did, that we'd see a larger impact of the policy shift on the labor market. And we should expect to see some labor market weakness this year. So that's the overview. Be happy to take any questions at this point in time, or I could kind of dive into some of the details, both what we're seeing nationally and some of the major sectors, and then talk what we're seeing more locally in Maryland. No? All
I
right.
have a question. I do have a
Please.
question, Andy.
Sure.
You said that you would expect to see, did I hear this correctly? A weakness in some sectors of the labor market. Did I hear you say that?
Yeah, I mean, so we've had.
If so, which ones? I'm just curious.
So you would expect to see, with rates moving up as quickly as they did, that's going to impact interest sensitive sectors of the economy, and as a result, you'd see a certain amount of weakness. I think the issue is, and again, these are my own views, is that I think in this particular instance, the transmission mechanism of monetary policy perhaps is going to be a little bit muted or delayed, because we're still the economy is still working its way through the disruptions from COVID. So if you think about interest sensitive sectors on the household side, that's going to be, residential homes. And we are seeing a big shift in terms of the demand for homes. And so home purchases are off, and as a result, household permits and new starts for single family homes is down considerably. And so you're seeing the impact that one would expect to see of higher rates on that particular sector. You haven't seen as many layoffs, however. So builders are still working through some of their backlogs, and you just haven't seen it. So it's interesting, you haven't seen as many layoffs coming from the residential sector, perhaps, as one might expect. And it could be the case that, one of the interesting things is that during COVID, it became so difficult to find labor over the last couple of years, I should just say. It became very difficult to find and keep labor. So it could be the case that firms are just very loath to let people go, even when demand softens, because it's so difficult to find people. And so part of the reason why you might not see softness even in this sector when you see a considerable downshift in activity is because firms are just, want to hold on to that labor. There's a term in economics, labor hoarding. And so we could see, there could be a significant, some amount of labor hoarding just because of people not wanting to let people go. So that's in one place. The other, if you think about consumers, the other side, the other part would be purchasing of household durables. And so there would be automobiles, furniture, appliances, and you do hear weakness there as well. But the interesting thing on the auto side, and this is where things get a little tricky, is that if you just look at the pace of auto sales over the last couple of years, we're short what we would have, the number of sales are much lower than what they would have been had we not had all the supply challenges due to not being able to get chips into cars. And so there's still a lot of purchases that need to be made. And so a number of cars that need to be replaced. And so while people would perhaps just lay off their auto sales and just delay those purchases, there's still a number of people that have to make those purchases. And so I think on the auto side, you're not going to see as big of a change as perhaps you would be, because there's a number of sales which should have taken, or number of transactions which should have taken place over the last couple of years, but which were unable to take place because of supply issues, but will take place despite the fact that the financing costs have increased. So that's on the consumer side. On the business side, you still have some of the same. And so if you're a business which has a fleet of trucks in order to service your customers, you have not been able to turn over that fleet like you normally do because of the inability to actually source trucks. The same is true with, if you've got a fleet of autos for your business. And so in the auto and truck, both light and heavy truck, there's still a number of purchases and transactions which need to take place that perhaps in other times they just say, okay, well, we'll just wait now and do this replacement or additions to the fleet. We'll do that later once financing costs come back down again. But that's not the case right now, because these purchases have been made or need to be made. I know in certain parts of the manufacturing sector, they're taking orders for 2024 just because they're fully booked out for this year, just because they haven't been able to keep up due to the supply challenges. And so there's one instance where you would expect to see a notable change in terms of investment by businesses, which I think you're going to have less of an impact due to the supply challenges of the recent years. And then on the investment in equipment, same thing. We've heard, depending on the particular type of equipment, firms have had a hard time sourcing pieces of equipment over the last couple of years. So you'd expect perhaps when rates go up, financing costs go up, firms would delay that investment. This is, they're still waiting for investment from the last couple of years. So that will continue to take place. At the same time, you talk to certain firms, they say, well, look, costs have gone up, but on a historic basis, it's still historically, the rates aren't extremely high. Plus, for a lot of businesses, the nature of their business is related to technology and efficiency. And really these investments need to be made in order for their business to remain competitive or to be more efficient. And so they're going ahead with those investment opportunities. And so you would expect to see, well, in the past, you might have seen a greater fall off in investment because of the financing component. I think that it's going to be less likely you're going to see less of that this time around because of the supply challenges and then the nature of investment nowadays. Does that make sense?
Yes. Although I will say that many of our board members certainly are concerned, and our members are concerned about the realities of what we're all consumers. We all have households and families, and we're all consumers. We're painfully, definitely seeing that both as as consumers and as business people. But one, other problem that's sort of in parallel here and you touched on it, is supply and demand, not only of products and durables, but of people. And in many ways, you know, I've read, all of us have read so many articles on the supply and demand of talent, and that was a problem before the pandemic. And I'm not sure that working with interest rates as a tool, which certainly addresses some issues, can in any way help employers with the issue of there's just not enough people out there. I mean, changing the interest rate does not somehow produce, you know, like a machine, more humans to hire. And people are oftentimes the biggest cost that any employer has. So we've got a completely other situation that certainly affects a lot of our companies here in the Washington region. And and a lot of people put that to a number of different issues, but, you know, one of them just is whether it's immigration or just, you know, just not enough people that have come into the pipeline, frankly, over the last decade, if not 2 decades, because of other policies. I just wonder if you have a thought on that.
Yeah, no, that's entirely true. And so the idea is, and I'll kind of go to the next slide. The idea is that with growth slowing, the demand for workers will ease, and so that should make the labor market less tight. And so the question is where are we going to feel it? And so I mentioned manufacturing. I mentioned household durables, also just construction in general. If you talk to, you know, people in the commercial real estate, higher rates are making it more difficult to pencil, you know, make larger projects work out in terms of the math. And so people are pausing in those projects. And so you should see a slowdown for certain in construction. You should see it at some point in manufacturing. One of the things that I'm really kind of focusing on closely is at what point do we see a significant slowdown in hiring and manufacturing. But at the same time, we've seen an explosion in terms of e-commerce both, and so that's resulted in hiring of IT people as well as in terms of investment into place in terms of warehousing. And so you would expect to see with less purchase of goods by consumers, because we've seen that exploded, and so you've seen that level off. So you should see some backing off in that space as well, and you're seeing some of that. And so, and again, when there's a slowdown in growth, a lot of firms, you know, after a period of rapid growth, firms often take the time to look at their labor pool and say, okay, where can we make adjustments so that we can become more efficient and improve the bottom line. And they're doing that with the eye towards, okay, getting to a place which is more sustainable over time, because just as it happens in the economy during expansion periods, firms at some point get a little bit labor heavy, and so they take the opportunity to look at their labor force and right side their labor force with the current level of demand and the expected level of demand going forward. And I think you're seeing a little bit of that. And so to your question about labor, it is true that a lot of people left the labor force during COVID and didn't come back. And I've got some charts which show that our region that impacted our region more so than others. Immigration is down, and so that's another factor. And so really, if we're going to get relief on the labor side, I don't think it's going to be additional labor supply, which is what people were hoping for back in 21 and 22. It's really going to be less demand, which will free up some labor, which would allow other firms which do need labor to hire those workers. And so really, I think it's going to come on the softer demand side. And just to kind of highlight what I mean in terms of softer demand. So here, this particular chart shows GDP growth quarterly for going back to 2007. You can see over the last 4 quarters of 2022, the first 2 quarters were negative, although they really weren't that soft. We had actually good consumer spending in the first half of the last year. Actually, we had good consumer spending for the entirety of 2022. It was was moderate for certain, but it was still solid, especially given weak stock market, high inflation, rising rates, uncertainty due to war in Europe and other things. Consumer spending held up actually very well, given all of these factors. Business investment was solid for the year. Was fine in the first half of the year. It was just because some special factors, export, imports, and inventories, which made the headline number negative in the first half of the year. And at the same time, the second half of the year, it looks quite strong. Those same factors made the second half of the year look a little bit stronger than it actually was. But for overall, for the year, you had solid consumer spending. Business investment was solid. For the year, it came in under 1%, so very moderate growth. Looking ahead for 2023, we're expecting, again, moderate growth with higher rates weighing on both consumer spending and business investment, but not enough to push the economy into a recession. I also have on here, we have on this particular chart, the projections from the FOMC members. If you look at the chart, you have these bars. The bars is the range of the views from the FOMC members. The red dot is the median. And then if you look at the numbers in the table in the bottom left, I have the median projection going back to the December 21 meeting. So 4 times a year, the FOMC members submit their projections for the next couple of years and for the longer run. And so in December 21, so a year ago, essentially, the expectation was that GDP growth would come in at 4% for 2022. And you can see that over time, as the data came in, we saw that that there's disruptions continue due to supply chain, disruptions due to the war in Ukraine, higher interest rates, all that weighed on growth last year. And so growth came in at just 0.5%. For 2023, this time last year, the median projection was for growth a little bit of 2%, which was a very solid year for growth. But again, given the changes in policies and other things we're seeing in the economy, expectations for another year of under 1%. However, I'll show you with the labor market projections, with the weaker growth for this year, there is the anticipation that's going to help relieve some of the tightness in the labor market. You'll actually see an increase in the unemployment rate over the course of this year. So I don't want to go through all these slides. I'll send this to you, and I apologize for skipping over some things which I know you really want me to go through in great detail. 2 things I do want to point out. One, I'll talk about on the manufacturing, because I do want to, that is a key sector of the economy. And so you do see considerable softening in the manufacturing sector. And so this particular chart it's an index put together by the Institute for Supply Management. And so they survey manufacturers each month, and they ask them if activity is increasing or decreasing. If the index is above 50, that means net more firms were saying that activity was increasing. And so if it's below 50, more people are saying that activity was decreasing. And you can see that over the course of last year, activity slowed considerably. So the red line is now, you see the red line dropping from near 60, which is a high level of activity, to below 50. And then the blue line is the new orders index. And so that's going to give you a little bit of a forward indication of where activity is going. If the blue line is above the red line, typically, activity overall is increasing, and at the same time, if new orders are falling, that means overall activity is falling as well. And so currently, new orders are approaching 40, and so you're seeing considerable slowing in the manufacturing sector, which again I would attribute to the rising rate environment, as well as the economy just coming off a period of just extraordinarily high growth. Due to the rebound from COVID, as well as a lot of the fiscal support that was made available to the economy. So that's one part of the story. But just to, when you look at the series going back, you can see that there are periods where the overall index falls, it gets close to 50 or falls below 50, but that doesn't necessarily mean that there's a recession around the corner. There's just periods where you've got strong growth in the manufacturing sector due to, it could be a number of different factors, and then you have a cooling off, and that's where we are right now. And again, as I said, there's certain parts of the manufacturing sector right now which are booked out until 2024, and that's because of just still trying to catch up from the inability to meet all the orders over the last couple of years because of supply chain disruptions. On top of that, you've got an infrastructure bill which is yet to hit the economy, and so there's going to be a lot of construction and manufacturing of goods in order to support that construction over the next couple of years because of the infrastructure bill. So when you're thinking about what's going on in the economy broadly, yes, there's a slowdown due to higher rates, which is impacting some interest-sensitive sectors. There's other places where things are still solid to very strong. And this is something that comes out when we go out and talk to firms. It's not uncommon for me to talk to a firm and they'll tell me about all the different challenges that are out there in the economy: tight labor market, higher inflation, costs which are up. They're stable, but they're just still, input prices are high but stable. It could be uncertainty from a lot of different reasons, but if you ask them, it's not uncommon to hear that last year was their best year ever, and that they've got very solid backlog coming into 2023. And so, so I mention that because you do see in a lot of the indicators softening in the economy overall. There's still parts which are very solid or very strong. And so again, when thinking about, well, what's the possibility of recession, it's tough to think about that when you have certain parts of the manufacturing sector which are still doing very well. If we were to go into a recession, in my mind, it would have to be something that would impact the consumer sector. Consumers are 2/3 of the economy. And so consumer spending, as we look at the first quarter, is quite moderate. And that's in part because spending on goods has slowed down considerably, as one would expect with higher interest rates. And just generally speaking, we're just having this rotation from spending on goods to services, which is highlighted in this particular chart. And you're seeing spending on services continue to grow. So this chart takes a look at consumer spending, both broken down by services and goods. And I've added in some trend lines, which for both services and goods prior to COVID. And you can see, just focus on goods, for example, just how much people weren't able to go out and travel and do other things that were in the service sector. So they spent a lot of, and plus there was additional fiscal payments. And so you can see that the spending on goods really skyrocketed. And so well above well above the trend that existed prior to COVID. Now you can see that peaked in 2021 and has moved sideways since. And so for 2022 overall, you could see that spending on goods was slightly negative. It was down 1.3% in the first half of the year and roughly flat in the second half of the year. Whereas in 2021, it was up 12%, which is just tremendous. Spending on services, however, stayed solid last year, above 3% for both in the first half and the second half of the year. And so we expect that trend to continue into 2023. Spending on goods is going to be soft, whereas spending on services, as far as is expected to continue, although it's expected to moderate some. And you can look at the spending on services, we're still below where we would have been absent the COVID shock. And so if you look at that particular trend, services has yet to catch up to where we would be. And so for that reason, we're expecting services to continue to move up back to that trend line. And so,
Andy, I'm sorry, this is Ann. Can you say a little bit about the super core measure that the Fed is using now and services? I've been reading about the super core as yet another measure of inflation that strips out things. It really focuses on services, and your comments about services I think are related. Can you say a little bit about that and how that relates to what we're seeing here?
Sure. Let me show you with a picture. So here, so when thinking about inflation, inflation overall, like the FOMC focuses on the PCE price index, and we have an inflation target of 2%. And you see that here, inflation in December was 5%. Inflation's overall expected to moderate to 3.1% is the median for 2023. Now, when thinking about inflation, though, the inflation, the PCE price index, that price index covers all the goods and services that consumers spend money on, right? And so, or all the goods and services that they consume. Now, one way of thinking about that is to look at all the different prices and kind of break it down into different pieces, right? Which is what you're referring to. This particular chart shows you the entire distribution of prices. So if you take all the price changes for everything that consumers spend money on and just rank them, the core of this is the core. So the core is going to be the weighted average of all those individual prices, right? This chart shows you the distribution. The light blue is the 20th to 80th percentile. The dark is the 40th to 60th, and then the dark blue line is the median. And you can see that we had a broad increase in inflation in 2021, which leveled off in 2022, right? So we would like to see not only, and so the question is, okay, what parts leveled off, and what parts are we continued to seeing strength in terms of price growth? Well, if you break it down to both goods and services, you can see that there's definite change in terms of how pricing has moved over the last couple of years. You can see on the left, you've got the distribution of prices for goods, and you see that that's actually started to come down in a meaningful way. So if you've been concerned about the impact of goods inflation on overall inflation, you can look and say, okay, things have definitely turned the corner. And that makes sense with the chart that I just showed you, because when spending on goods skyrocketed in 21, obviously, firms don't have those items on the shelf. And so you're going to have a demand increases, supplies going to have a challenge meeting that demand. And so prices are going to go up. And then supply chain exacerbated the problem of actually producing those particular goods. And you had the rapid rise in inflation for goods. And now with demand leveling off, it's still at a fairly high level. But now with demand leveling off, you're seeing relief in terms of lower increases. You're seeing significant disinflation on the goods side. Now let's look at services. Now you saw that we're still below where we were in terms of the level of spending on services. And so you're still seeing a certain amount of, there's just a certain amount of underlying strength in services as we get back to what would be a normal level of services given consumers and income in the economy. And so you're still seeing strength there. Now, when you look at core services, what do people spend money? Actually, what most of people spend money on are services. And if you just look at the history of inflation, normally goods actually subtracts a little bit from inflation. And that's because we're always quality adjusting for goods. And so the car that you buy this year versus last year is going to have additional features. So if you adjust for quality in apples to apples comparison, you're actually getting a cheaper car. And that's the same is true for all electronic goods as well. So what really kind of drives inflation over longer periods of time in terms of the trend is what's going on with services. And in services, what we spend most of our money on is housing, healthcare are the largest two. Now, one thing that Chair Powell has been, when he talks about inflation nowadays, he talks about we're seeing disinflation in goods. So you can see that on the left. And then he talks about housing because it's such a large component. And it really reflects the dynamics of one particular market which is what's going on in the housing market, the multifamily market. And so there we're seeing that over the last, I think, 5 months now, maybe 6, that the rent growth has really slowed. In some places, depending where, has actually softened considerably. And so that's really important because since it's such a large component, it really can drive the overall index. And what you saw, and I wish I had it here, you saw that the inflation for the rental part of services really picked up in a strong way in 2021. So with that softening, that would really ease, help with some significant disinflation on the services side. So there's goods, there's housing, and then there's X services, X housing. And there we're talking about recreation, we're talking about travel, going out for restaurants and dining. And there you just really haven't seen much change in the rate of inflation. When we go talk to firms, there's still capacity issues. And so there's a lot of different reasons why you're not seeing capacity open up, such that, there's still some restrictions on supply and demand is very strong. And so you're still seeing very strong pricing for those particular services. And you see that here in this particular chart. Overall pricing, the distribution of prices for services has, while it's stabilized, we've yet to see any meaningful disinflation. So the next part for 2023 really is going to be looking at these other sectors. There's going to be continue to monitor the housing to see how much, and we should see that in the second half of 2023, some disinflation, because again, it's inflation's year over year. So by the second half of the year, we should see the impact from lower rents should help with disinflation overall for the overall metric. But what we focus on is what we're seeing in these other service categories and see to what extent we see a softening in demand from the economy moderating, and to the extent that we see greater capacity become more available in the service sector, which would also help. Does that answer your question?
Oh yeah, that's terrific. Thank you, Andy. It looks like Bill has a question.
Yeah, go ahead.
Thanks, Ann. And Andy, thanks so much. This is fascinating and extremely educational. One question, though, when we talk about the impending infrastructure spending, which will really be unprecedented capital infused into the economy, how will that stress on the supply chain, because there will be additional stress on the supply chain, both goods, services, workforce, affect the economy? I do worry that with all of the added investment that we'll probably see around the summer of this year, when we start to see projects breaking ground and so forth, that a lot of the service industries and construction and so forth, which are also major consumers of goods, they'll start to drive up demand with shrinking supply, or at least stress on supply. So I do worry that the inflation we're seeing, maybe there's a lagging indicator of what's to come. So can you speak to the infrastructure spending that we're about to see and how that might affect good or bad inflation? And thank you very much for your presentation.
Yeah, no, that's a great question. And again, so within the literature, there's a lot of focus on the impact of trying to kind of gauge the impact of monetary policy, both in the magnitude and the timing. And there's a lot of you get a lot of different results depending on the models and the assumptions. And in this time period, as I said before, there's just a number of different factors which would make one think that the impact of monetary policy is going to be more muted and have greater lag. One of them is just, again, lingering supply chain issues, catch up from orders that we weren't able to meet over the last couple of years. And then one's lingering fiscal policy, that there's still certain amount of stimulus that households are sitting on or able to deploy in terms for consumption. And then the other one's the infrastructure bill for sure. And so talking to a lot of different firms, I've heard same concern made that you just made, which is how is, right now costs have leveled off. And so that's been extraordinarily positive for inflation. The dynamics, I think, as we all know at this point, was that because of the uncertainty and inability to source certain goods, firms were bidding up costs for materials. And in that environment, we're easily able to pass along those increases in costs into higher prices. And we just got in this cycle where people were last year had multiple price increases because of this dynamic. Whereas this year, given where we are, which is very positive, you talk to firms and say, okay, my supply chain is for the most part manageable or better. So I'm not having these cost increases. I'm still dealing with labor. So we're pushing through perhaps one more price increase. But with this, we think that our margins are pretty good and we're okay going forward. And we think our wage rates are about right. So going forward, we should be good. But we do, on the construction side, there is this question, will the infrastructure spending, will that impact the ability to source materials and cost for those materials in the future? And so that is definitely a risk. I think, but at the same time, you're hearing that for other projects, things are being pushed back. And so you've got two different effects taking shape. And so it's difficult to net out both those factors. One, of course, being the infrastructure spending, the other being higher rates and people putting off projects. And we talked to different firms, and there is a significant amount of people who are saying for larger construction projects that with higher rates, it's difficult to do the math and pencil them out. And so they're going to wait until they get a better idea of what the path of rates is going to be both for this year and next. Because if you look, and I'll show you in a moment, the dot plot, the projections for the federal funds rate over the next couple of years. And so we are hearing about a number of people delaying projects. And then on the, that's both for, across a number of different commercial real estate types of sectors. And so I think that will help. How it nets out will be interesting to see. But I really do think that with a focus on where inflation is, that should it be the case that the infrastructure bill creates issues with costs, which could ultimately impact inflation, I think what you'll see is, and again, these are my own views, if that's a concern that costs are increasing, which might result in higher prices being pushed higher, that the FOMC would respond with higher rates or higher rates for a longer period of time, and that would dampen other types of construction. So net, I think it would help alleviate any potential supply chain problems that might be created by the infrastructure bill. Does that make sense?
It does. You had me until raising interest rates, and I do worry that would have a chilling effect because it would affect the individual consumer, the families and so forth, more so than the larger manufacturing industry, I think. But very, very helpful analysis. So thanks, Andy.
Yeah, sure. Well, I mean, at the end of the day, I mean, and this comes back, it's a lot of what the uncertainty about what the terminal rate is going to be for this particular cycle is something that is creating a pause for a number of different construction projects. It's not canceling them, but people are like, okay, I need to know where rates are going to be in order to pencil out certain things. And so if it's the case that there is concern and just concern about inflation due to supply chain or anything else, tighter labor market, then I think that pause would help forestall the infrastructure bill. But again, going back thinking about the infrastructure bill, that's something that's going to be, yeah, it's going to start. We're starting to see that money hit now, and it's going to be extended or impact. It's going to be felt for a number of different years. And so, I mean, again, thinking about it, it's not going to hit the economy all at once. And so while it's provide a certain amount of support, it's tougher to see it being significant enough to really impact supply chains in a big way like we saw with COVID. So that's another thing that I would add to that. But to your point, you're at higher rates. We do see that for certain for households, higher rates are impacting consumers, and that particularly consumers at the lower end of the income scale, and that's impacting their consumers, their consumption, and their ability to make it to the end of the month.
Yeah. Thank you, Andy. Really, really helpful and great insight.
Sure. So let me go back just briefly for the labor market.
Andy, before we continue, we do have a question. I see a hand up from Mel Tull. Could you entertain a question? I know we're tight on time, but
Sure.
Mel's been waiting so patiently. Mel?
Oh, yeah,
Yes,
yeah, please
thank
go
you.
ahead.
Andy, it's a segue back into the labor market, because one of the curiosities to me is that so many people aren't back to work yet. And as a grandparent who did a fair amount of babysitting during the COVID episode, I'm wondering if all these things I read about people who aren't back to work because they don't have childcare is something that can be dealt with, or if we dealt with childcare, can we get enough people back to work that it would make a difference?
Yeah, that's a good question. What's really interesting is that it's taken a while. Some areas have taken longer to get for their labor markets to kind of fully recover. So for the U.S., if you look at just kind of in terms of the number of jobs, we're now back to pre-COVID, above pre-COVID levels. So this particular chart shows the level of employment, and it scales to February 2020. So if you're back to above 100, so the U.S. is slightly above where it was in February 2020. For Maryland, the Baltimore metro area, and for the DC metro area, we're still below where we were pre-COVID. And again, the question is why? And again, to your point, it goes to the labor force. And so here we've got same chart, but it's looking not the number of jobs, but the labor force. And that's the number who are people who are either employed or who are looking for work, but don't have a job, the unemployed. And so you see the big difference between the US and Maryland, Baltimore MSA, and the DC MSA. And the question is why? Childcare certainly is part of it. I've got a coworker who did an article who looked at labor force participation. The data's a lag since 2021, but it looked at it for Maryland and Virginia, and it was broken out by different demographic characteristics. And what was really interesting is that for Virginia, the big change net was decline in labor force participation of men, and for Maryland it was women primarily. And you can kind of see that, and this, I know this is kind of an very much an eye chart slide, but I think it's interesting if you look at where jobs haven't returned to pre-COVID levels in the state of Maryland. A lot of those are occupations which are held by women. So if you look at education and health, for example, it's still nearly 6% below February 2020 levels, and that's 28,000 jobs, that's a large number, right? That's even larger than the leisure and hospitality. We've heard a lot about difficulty getting people back to leisure and hospitality, but because it's such a significant sector for Maryland, that's a lot of jobs. 10% lower in educational services, so that's 9,000 jobs, and then in health services. And my thinking on this is that because Maryland's a high income state, you had a number of women who were engaged in the labor market in dual income households where that second income perhaps wasn't as necessary. And so when it became more onerous to be in the labor market because of just the COVID challenges and or childcare, elder care, they had the option of staying home. And so that option became more attractive. And so they exercised that option and they left the labor force. And that's why, according to my colleague, when you look at the decline in labor force participation in the state of Maryland, it's mostly women. And you can see that in some of these occupations. It kind of bears out if you look at these occupations. And so going forward, would childcare, more affordable childcare help? Certainly. And I think that's true nationally. If you look at nationally, the labor force participation of women for the US peaked in, I think, 2000 and started to decline a little bit. Whereas if you look in Canada, it continued to increase. And so whereas they were somewhat similar in 2000, now there's a significant gap in the labor force participation rate between Canada and for women in Canada and the US. And we try and kind of tease out why that might be. Childcare is certainly a factor. So I think that's something that would definitely be helpful in order to help people get back into the labor market. But I think that's just part of the story.
Thank you.
Sure. Yeah, and so, but again, so clearly that's an issue facing, Maryland. And I also did, just if you looked at the county level for Howard County and for Montgomery County, it's the same thing. Still close to, for Maryland, down nearly 5%, for Howard County, 4.28%, and for Montgomery County, 6.19% below where we were February of 2020. And so again, for a variety of different people have left the labor force and just haven't come back, and it's going to take I think it's going to take some time before we see that return. So we are running a little bit low on time, and so I'll finish off with where we are in terms of policy. The most recent FOMC meeting rates, the FOMC, as I mentioned earlier, raised the target range for the federal funds rate to 4.5 to 4.75%. And again, so the committee stressed that ongoing increases in the range will be appropriate in order to attain a stance of policy that is sufficiently restrictive to return inflation to 2% over time. And this is something that Chair Powell stressed in his remarks yesterday. And he said that at this point, at the current level, it was not viewed that the level of the federal funds rate was sufficiently restrictive. And as a result, additional increases would be necessary. If you wanted to think, well, how many more increases should one expect this year? So I have the median project on the right is the most recent, what's called the dot plot. Each dot represents where an FOMC member believes the federal funds rate would be at the end of the year under appropriate monetary policy. And so this was December. So, obviously if the first column on the left is for 2022. At the end of the December meeting, they knew that rates would be between 4.25%, 4.5%. And then for the end of 2023, there was a range of views where there's two FOMC members believe that, that the FOMC, the target rate for the federal funds rate should be 50 basis point higher. The median view was that should be between 5 and 5.25%, with some other FOMC members believing that should be higher still. I also have on this chart also on this chart is the dot plot from this time a year ago. And you can see how, again, one of the things I've kind of highlighted and put on the slides is just how much 2022 came out to be was much different than anticipated, with inflation picking up much more than anticipated, growth being a lot slower, and the labor market remaining tight. And as a result, you had a very big shift in terms of policy. So you can see that just quite dramatic in terms of the dot plot from this time a year ago versus now. What's also really interesting is for 2024, there's obviously the range of views for where policy should be at the end of 2024. That range is quite large. And again, so one would interpret that to be, how is inflation going to evolve over this year? There's a lot of different thoughts on what we should expect to see. Again, the question is persistence. How persistent is inflation going to be? Part of it is supply chain. If it is the case that all of a sudden in those areas where we still have issues like getting chips into cars, if that were to resolve itself very quickly, prices for automobiles and other things and other items would come down very quickly, so depending on how you view that, that's going to impact your view for inflation this year and next, and ultimately policy. And then the same thing that which goes back to Gigi's question about the labor market. How much loosening should we expect to see in the labor market this year, with rates as high as with rates where they are, and the economy slowing? And there's still a significant amount of uncertainty, just because we hear from firms that they're going to be less likely to let people go during this cycle because it's so difficult to find people. And there's still factors which are leading the economy to have strength in certain sectors, like in construction, like in manufacturing. And so it's not quite clear to what extent we'll see softening in the labor market over the course of the year. And as a result, for 2024, there's a certain significant amount of disagreement in terms of where policy should be. And just to kind of wrap up, and so I can take some additional questions. Very slow growth is expected for this year. I think that we'll avoid a recession because there's still a significant amount of strength in parts of the economy, absent some other shock, which doesn't mean that we won't. That's still possible. So there is a heightened downside risk, but I think that absent that shock, we should see just solid growth. The labor market remains very tight, as I've said. And again, the key issue is with softer demand. To what extent will softer demand temper the labor market? Importantly, inflation is moderating. We've seen this over the past 5 months. How much more the pace of moderation in 23 is, there's a lot of uncertainty about that. I think we're most certainly in a better place. As I said earlier, talking with firms, it's been a battle for margin, with costs increasing first on the materials side, and then on the labor side, it's been difficult to maintain margins. A lot of the firms that I've talked to, they're either with the most recent price increase, feel like they're pretty good both with their margins and with their wage structure, or they're in the process of perhaps pushing one final price larger than normal price increase, and they'll be set. And so I think we're out of those dynamics, which result in inflation moving from where it was, moving much higher in a short period of time. The question is going forward, how much relief on price should we expect to see in 2023? And there's a significant amount of uncertainty. And then based on how we see the data come in, both on the labor and inflation side, the FOMC will respond with additional rate increases, with the median Fed funds rate projection at 5.1%. And with that, I'll go ahead and stop and take any additional questions.
Hi, Andy. It's Lowell. Hope you can hear me okay.
Yeah.
Good to see you.
Good to see you.
I do have I hope this isn't too technical of a question, but we've got an inverted yield curve. And, over in history, and your inverted yield curves would suggest that the market thinks there'll be a softening in the economy, which then will result in lower rates in the future than they are currently. And another factor that many times a recession, the last thing right before a recession is a credit crunch. Right? So it's what causes the liquidity in the market really to disappear. And when I look at what's happening today, and again, I don't mean to inside baseball here, but when I see these increases in interest rates that have happened, the key metric that we use and the banking industry uses to underwrite credit and give access to capital or cash flow coverage ratios or fixed charge ratios, things like that. So when you start to see an increase in interest rates, it means your debt service goes up, which means those ratios get squeezed unless your margin is sufficient to make up for those. And I can tell just in my own, I see the risk ratings that we assign to clients have gone up because those ratios have been squeezed. And I'm curious, but the banking industry is very, very sound in general in its capital base and all that. So I'm not sure that I see the banking industry being a result of not having access to capital, but I do see squeezing in these margins, which means that the banking industry willingness to extend credit with those types of ratios are going to be more restrictive. And I'm just curious, do you see, is that playing in a factor anywhere from the inklings of a potential credit crunch anywhere, or do you not see that across the whole spectrum?
Yeah, no. So, thanks for the question. Again, it's good to see you. We closely watching credit conditions as indicator that things are getting worse in different sectors, and you have seen an increase in some delinquency metrics. But really, what we've seen so far is return to pre-COVID levels, and that's what makes, I think, it a little bit difficult to interpret what we're seeing now, because the economy has been so unusual over the last couple of years because of fiscal stimulus, because of shutdown, reopening, and the reopening had really strong growth because you're trying to catch up on all these orders you couldn't fill. You had delinquency levels that were much lower than historical levels. You had the level of activity at very high levels. And so what you're seeing now is, in many cases where you do see a softening, we talk to a firm, we say, okay, things are a lot softer. And they'll say, oh yeah, we're now back to 2019 levels, which we're happy about, because now we can work, our workers we can't do 60-hour weeks in perpetuity. And so that's a good thing. And on the credit side, we're seeing some of the same. Importantly, the banking system's in a very good place. And so often what happens with recessions, there's an imbalance built up in a particular part of the economy. There's a lot of finance which is directed towards that particular sector. And so when the contraction hits, there are losses, and then that's because it's in the financial system, it's propagated through the economy and has a much bigger impact. It's really difficult right now to see where there's an imbalance in any particular sector of the economy. And there's really difficult to see any particular place where there's an extension of credit or leverage, excessive leverage in any particular part of the economy. It's definitely not in the banking system, because we have a lens into that. It could be in some other segment of the economy that it's difficult to see in the financial system that's unregulated. That's possible, but from what we're looking at, it's really difficult to see. And I mean, rates have been really low, so people have been able to to refinance and to have debt service burdens which are extraordinarily low historically. And so at this point in time, from a financial perspective, both businesses and households, historically things are in a fairly good shape. That's particularly true with banking. So it's tough to see where we have that imbalance that would result in a significant deterioration in the credit situation. It really is. And so it's one of those things where I have it for this particular FOMC cycle, is to find those firms which are most likely to be distressed and ask them how they're responding to deterioration in their business and industry conditions. But there's just, again, there's this particular softening is not like other softenings that we've seen. And so, yes, it's true that the yield curve's inverted, and that's been true. I think the inverted yield curve is predicted. I can't remember the sayings, like what, 9 out of the last 5 recessions. So it's right. It's inverted before and not been indicative of a recession, or a recession hasn't followed. But I think the conditions this time, you should always be careful when people say this time is different, but you do have a sense that this time is a little bit different. And also, I've said before, the Fed engineering a soft landing, right? How often does that happen? But, right. But this has been such an unusual experience with COVID shutdown, fiscal support, strong economy. So this time is most certainly different. So we'll have to see how things work out. And so Mel has had his hand up for a while, and then Andrew.
My mistake. I should have taken it down.
Okay, so Andrew, please, Eagle Bank.
So Andy, thanks for being here. And just following up on what Lowell said, I was at the Economic Club yesterday and I waited and waited and waited for Rubenstein or Mr. Powell to bring up a recession. That word was never mentioned once, unless I missed it. It was never mentioned once. And I found that very interesting. So with your comments today, I really find it interesting that obviously the Fed, and this is your opinion too, is not looking at a recession for this year.
Yeah, no. So if you look at and if you look at the projections for the FOMC members, they're not anticipating a recession. And I want to be more pessimistic. I really do. If it warranted, I'm not just a happy-go-lucky person, so it's actually on my to-do list for this cycle is to really find those firms things are really deteriorating and they're anticipating, okay, we need to lay off a lot of workers. We're needing to cut prices because inventories are building because the demand's not there. Things that would be typically happening should a recession be imminent, right? You need to cut workers, cut costs. Inventories are increasing more than you want because demand's fall off. And so that's my task. But it's really difficult to be really pessimistic when you have $1 trillion in infrastructure spending coming through. You still have parts of the manufacturing sector which are built out until 2024. There's a lot of people that I talk to that their backlogs are, they're the largest that they've ever been. And you ask because backlogs can disappear, right? And they said, no, we've got some hard purchase orders. And so there's more often than not, when I talk to firms, things are solid to strong. And if things have softened, it's just to 2019 levels. So we're kind of back to normal outside of housing, right? And outside of some of the construction.
But the tech market, there's been a lot of layoffs in the tech market.
Yeah, but here's the thing. So the unemployment rate of somebody in the tech sector's got to be below 1%. I mean, so if you're gonna, so when you look at people, that's just going to be a reshuffling. And so if you wanted to say there's an overinvestment in any particular sector of the economy in the last couple of years, it's okay, well, we've moved everything online, right? Education, health, the acceleration in e-commerce. So we threw a lot more money at that infrastructure, right? Both on the IT in terms of people, as well as equipment, as well as space. And so we heard Amazon's pausing in its industrial build out. Okay, so that would be an indication of perhaps some overinvestment. But the vacancy rate in industrial space is still 2%. Yes, Amazon's paused, but the vacancy, so you talk to people in that sector, like, yeah, but the long-term trend is still that, and the vacancy rate's 2%. The long-term trend is still IT moving things online. So if there's a reshuffling, where we're seeing some reshuffling, and perhaps there was an overextension, is in one of the trends, which is the strongest long-term trend for the economy. So it's tough to see how that's going to fully kind of be something, a strong negative. I would expect all these people to find work in a fairly short period of time.
Thank you.
Andy, I have a follow-up question to Lowell's a question about the risk of, the tightening of credit. And I'm wondering if anybody has their eyes on the impact that has on the universe of small businesses. I mean, we're talking about manufacturing and, a lot of big things. But most of the economy is made up of small businesses, and in federal contracting, which of course the greater Washington area, Maryland, certainly has a lot of small business federal contractors. And I'm wondering if anybody is looking at, whether or not small businesses are, maybe individual banks are seeing this or not, I don't know. But if they're having to tighten their lending practices, the extent to which it hits small businesses, which really also means the extent to which it hits disadvantaged businesses, women-owned, veteran-owned, minority-owned, that sort of thing. I'm just curious. The thought popped into my head while Lowell was asking you the question. Do you have any thoughts on that?
So I'll do a plug. So we have a small business credit survey, which we do. It's annual, so it would pick up signals obviously at a lower frequency than what you're asking about. But we do focus on not only just the sector, but demographics within the sector, different populations, how they're being impacted by overall credit situations. But that's trying to get at the overall landscape. Although that survey was particularly useful when trying to figure out how COVID and some of the relief policies, how that was helping, and how different sectors were being impacted by COVID, and how the different policies that were put out to help small business, how effective they were. So we do that survey. But when we go out and talk to businesses, we talk to businesses from single store retailers to global companies. And so one of the things, thank you for suggesting that. And so for my upcoming cycle, I'll make sure that I talk to a number of small businesses to see if we're hearing any of that. Because again, one of the things that we find really important, actually Chair Powell mentioned this yesterday a couple of times, is that we and the other reserve banks, one of the strengths that we have is this outreach program, because you can watch data. You can look at the data as it comes out, but you're not going to pick up some of these other emerging trends unless you actually go out and talk to businesses. I've yet to hear anything about credit conditions. But again, we're in this interesting place where the unemployment rate is 3.5%, 3.4%. Job growth is really strong. You wouldn't expect to see households pulling back in the middle of a tight labor market, because there's job opportunities are out there. Wage growth is although inflation's high, nominal wage growth is above normal. That should support the household sector. And at the same time, businesses are hiring because they need workers. And it's in these conditions, you wouldn't expect to see a dramatic fall off in credit quality anywhere. We do hear for example, in subprime, there's definitely for lower income households, lower income businesses, or businesses that support lower income sector, that yes, there's stresses there. But overall, this is not the time where you would expect to see these stresses taking root. Although it'd be good to reach out to some firms to confirm that.
Well, if you decide you'd like to do that, especially in the not only in the federal contracting sector, other small businesses as well, just as we did the roundtable for life science leaders, that for you and Tom, we're happy to bring other groups together or make it easier for you to access some of those conversations. We're happy to convene for you.
Well, that'd be fantastic. We'll have to follow up and do that. I think I saw another hand, but I think the hand went away. That was Erin, but she's on mute.
Erin, you're on mute. There you go.
Yeah. So I don't know if this is going to be fast. So I have a question that I've been wondering about for a while. So with so many of us, there you are working from home, so am I. And a lot of vacancy rates are starting to edge higher. And I'm feeling like, and this is just, pure conjecture on my part, that has to be a sector that's really going to be affected in these next 3 to 5 years as people are downsizing and maybe moving away from office space at all. Are you concerned at all about what that might do to us as a whole, as an economy? I mean, DC in and of itself is reaching out and raising their hand and screaming about like the effects on their economy on the day-to-day Monday through Friday without those office workers.
Yeah, no, yes, for certain. And so it's, the central business districts, depending on the city that you're in, very much hit. And so from an economist point of view, it's like, okay, so where does that activity get diverted? So there's somebody benefits, somebody loses. But for, the District of Columbia, yeah, so on Monday, Tom and I were meeting with a large commercial real estate firm in Washington to just get their view on, the commercial real estate market broadly, and as well as in the city. The big question is, okay, so, we haven't seen rental rates decline as much as one would expect. There's a lot of things where you haven't seen movement as much as one would expect given everything. And so why is that? It's coming. And then when it does, what happens when you reprice those buildings? Who takes the losses? Are the losses significant enough to have a bigger impact outside of that sector? It seems to me to be the case that there's just a lot of money available for commercial real estate. When I talk to firms, people who in that sector say there's just a lot of money that's either being deployed or waiting to be deployed. And it's just, at the end of the day, there are some people that'll take some losses, but there's some other people that are willing to pick up those properties at a lower price point. And so net, which is, the economy, there's going to be winners and losers, buyers and sellers. As long as the changes aren't big enough that it creates disruption elsewhere, it's just how things work. And so from what I've heard is that even though you could have some significant repricing of assets, should things not change, it wouldn't be large enough to have a bigger disruption to the financial system. But it is, something that's constantly, we talk to people, it's like getting back to the office, right? Unless I'm traveling, I'm in the office, but my commute is small. There's just all these trade-offs that people are facing, and what the future of work looks like is still very much up in the air. I'm of the view at some point things in the future will look much more like they did in the past, because I think firms are realizing that not having people back in the office, there's things that are being missed that perhaps we can't fully quantify at the moment, but will become more evident over time.
All right.
Gigi, we've reached our 10
Yes.
p.m. cutoff. So I don't know if there's, if we want to just put a pin in it and stop here. Let's do that. Gigi, let me start, and I'll hand it off to you and Joan to finish up. Andy, thank you.
Sure.
I personally really enjoyed it, and thought there was an incredible amount of valuable insight that you offered, and I can't wait to have you back again. It's always an interesting time in the economy when you provide your presentation to the Montgomery County Chamber. So thank you. And with that, let me hand it over to Gigi and Joan for the final words.
Thanks, Brian. Joan, you first, please.
Yeah, Andy, again, I echo what Brian said. Very important. Periodic.
Hey, Joan, you're going in and out. I can't hear you. We apologize.
So on that note, I want to thank our incredible chairs, Joan McLaughlin and Ann Kademian. Thank you, Brian, for organizing this, and most especially Andy. Thank you for joining us again. And thank you to everyone who joined us today. Your time is valuable, and we appreciate it that you spent it with us. Thank you, and we hope to see all of you at our next meeting. Have a great day.
Thank
Bye-bye.
you.
Thanks for
Have a great
everything.
day.